All right. So, once again, good evening, everybody. Everybody, welcome. This is once another.
Engineer Bath, please,
Yes.
before you continue, can I say a few things?
Go ahead. Go ahead.
I wanted to let you know that I did my exam this afternoon
Mm-hmm.
and I passed.
Oh, that's
And I
good.
cannot thank you enough for the encouragement you and Dr. Ruth
That's Miss
and
Joy.
Dr.
Okay, Miss
Benny.
Joy is speaking, I
Yes,
think.
that's Dr. Yes.
Dr. Joy, you're welcome.
Yes. So I said, no, I have to also come back to the program to at least where we should also celebrate those who have done well, not just
Yes.
Congratulations.
So, Miss Joy,
thank you.
Miss Joy, are we seeing you in Dallas?
Yes, I've paid for my ticket already.
Oh,
Even
that's
before this
wonderful.
exam.
That's wonderful. Now, Dr. Ruth provided you a hotel accommodation.
Yeah, well, Benny, she was there.
Oh, Benny,
They're working
Dr.
on it.
Benny.
Yes,
All right, all right,
yes.
all right. So you're welcome. I see you in
Thank you
Dallas.
so much.
We're gonna celebrate it in Dallas. You're welcome.
Yes,
See you in Dallas.
All right.
yes,
Okay, so you guys, please just keep on. You will all make it. If I was able to make it, I'm sure you will. This is my second time of trying. I didn't make it the first time, but I make it now. And I knew it was my fault. There are 2 exams. We have to be sure. Make sure you finish and do the second one. I just did my one. I didn't realize that there were 2. And then when I now closed up, I saw that I had 35 questions to do in 10 minutes. That was what happened the last time. Yes.
Sorry.
Even with that one, I made 63%, but at least this one I passed this afternoon. Yeah. So
yeah, what we need is just 70%. We don't even need 71, just 70.
Yeah. So I wish all of you the best. I have to be also switching off now.
Thank you.
Just to encourage
We're happy
everybody.
for
Yes.
you.
Yes.
Yeah.
All the best.
You're
Engineer
welcome.
Bad, I'm very
much.
grateful. Honestly,
You're
you've
welcome,
done so well for me. Yeah.
You're welcome.
But I'll see people in Dallas by
All
God's
right, I
grace.
see you in Dallas. You're welcome.
Take care. Bye.
You're welcome. Yeah, welcome. Yeah. Yeah. All right. So this is what we want to hear. People should pass. Honestly, just like I said before, this exam is not difficult. But the problem is this, all of us, including me, because we have a lot in our hands, a lot in our heads, both work, coming from work, children, house bills, this and that. So you have little or no time to pay attention to it. That's just the thing. But if you make it as a duty to give at least 1 minute of your time daily, with the one we are doing here, and you read on your own, you get it done. Honestly, it's not difficult. She would have passed it in the first one if she had known that she have to do the second part of the exam. So based on that, that's what I'm going to show Miss Precious Nakayoma now. I want to show you guys something based on what she just said now. Because the exam is, you have to know the process, what is there, what is contained on the exam, and you have to know all those before you can make it. Otherwise, you go there, you get confused. So this exam, once again, is in 2 parts. It's in 2 parts. We have the federal or national. The national is predominantly what we are doing. But you know, one good thing about it is, even some of the things we are doing in national, you will see it in states. Some of the things are the same. So that's why, remember, when if I at the process, I will say, please check on your state. That is, some of those things are the same thing. So it's left, if you know that there is national part and there is state part, that makes it easy for you. So that when you're on the exam, you will remember that you still have 35 questions that you have not done. So that will help you to move forward. And if you, no matter how, if you like score the national 100 over 100, you will fail. That is the truth. The national is 110 questions. The state is 35 questions. So if you score the national 100 over 10 over 100 over 10, which is that, we just call up them, and you did not do the state, you're not going to pass. That is the truth. But if you did well on the national, go to state, did well, you pass. Even if you did well in one and did good in the, you didn't do good in one, do good in the next, for the fact you have done the other one, get something out of it, you will pass. But if you do only national and you didn't know there is state, you leave, you're not going to pass. That is the truth. So based on that, for these people that just entered today, I want to show you guys something. I'm using Excel Solution. We thank Excel Solution for being part of this program. That we are using them to teach people. This is their format. Whatever here is made by Excel Solution. They are so good. Somebody can have it to help you to pass too. So we are using Excel Solution. We have Excel Solution and ExamFX, but I prefer Excel Solution. Some other people want to use ExamFX. It's good too, but Excel Solution is what I'm using now. Now, the other person say she is from Ohio, another person says from Florida or what, Minnesota. So I want to show you something. Everybody see my screen? Is everybody seeing my screen?
Yes, Professor.
All right. So I want them to look at this. This exam I said, just like I said, even Miss Joy confirmed it, is in two parts. The first part, when you start the exam, you see the first part. That first part is the national. It contains 110 questions. Then the other part is the state, is 35 questions. You see? So the one from national is 110 questions. The one from state is 35 questions. So based on that, what you will do when you go for the exam, you start with the national. That is normally going to start with the national. You finish the national, they will ask you this question: do you want to continue, or do you want to end the exam? Of course, if you don't know, you have seen that you have answered all the questions, you say, yes, I want to end the exam. They will end you, and you fail. So you have to know that when you start the national, you finish the national 110 questions, they ask you, do you want to end the exam or do you want to continue? You press continue. You have to say continue. If you say continue, it will now get you to state. So because most people do not know that the state is there, when they ask them for the fact you have finished the national, they ask you, do you want to continue the exam or do you want to end? Of course, since that you have answered all the questions, you will say end. And when you say end, the exam will end, will log you out. However, you have not done 35 questions, which is the state. So if he asks you, do you want to continue the exam or do you want to end? You will always say continue. When you finish the national, you have to click continue so that they will not take you to the state part, which has 35 questions. So basically what we are doing here is more of the national. That's why all of us from different states are in this platform now listening to this. So I want you guys, Precious and Akuyoma, to look at this. If you have Excel Solution, and if you have Excel Solution, you have to go here and see where I highlight. This place I highlight. Did you guys see the place I highlight? Do you see my highlights? I'm talking to
tell them what it says.
I'm talking to Akuyoma and Precious.
And Precious.
Yeah. I don't know whether they are listening.
I think they mute the mic.
Yes, sir, please. Yes.
All right, you are hearing me?
Yes.
All right. So you see where I highlighted?
Right.
All right. All right. So if you are from Minnesota or from Ohio or from any state at all, where you see they write this place, they say Texas Life and Health Pre-Licensing. For your state, what they will write is Minnesota Life and Health Pre-Licensing, or Ohio Life and Health Pre-Licensing, or Maryland Life and Health Pre-Licensing. That's what you see. So you come down here, this place they say download review notes, state laws and rules. You click on it, you download everything concerning your state. If you click on that, you will get everything from your state. You review it. That's your state part of the exam, which means you have to review it before you go for the exam. Or otherwise, you're not going to do good on the state. The good thing about the state part of the exam is easy. Believe you me, the state part is very easy. And often it does not have any scenario questions. That's one thing good about it. The state part does not have any scenario questions. So, because it does not have any scenario questions, it's very easy. It's one just question that you just get it correct. So do not miss the state part. It's very easy to do. So if you download, you click and go through all the things, materials about the state. We read it, Now, if you have exact solution, you come down here. The last one, you come down to the last one. What you will see here will be Texas, it will be Ohio Life and Health Insurance Laws and Rules, or Maryland Life and Health Insurance Laws or Rules, or Minnesota. That's what you see. So you click on the review, you do the review, then you answer this question at the last one. That will cover you about the states. That will automatically cover you about your state. So for each of the states you registered from, definitely you have something like this. If you have exam FX, good. Still go there. You will see where they specifically name your state. If you see where they say their state law, just click on it and read it in exam FX. It's still the same thing. So most of the times we'll be on this review, you will see some of the things I will mention. I say, please note down. If you have a pen, write it down. That such a thing, you may see it on the state and equally on the national. So we have started this before you come. We are now on chapter 6. However, most times we used to, if we finish up, we still go back from beginning. That's what we do. We finish, we go back, we finish, we go back. But for people that are going for the exam, we're not going to go back. We are going to continue with chapter 6. So follow us, start from chapter 6. Ask questions. Do you hear? Almost everybody here are adult. I don't think there's anybody below 20 years here. I don't think so. All of us are old mama and old papa. And that makes it easy for you to open up, ask questions. Anyone who does not understand, you ask questions. However, it's not even a question of understanding. Anyone that's confusing, because I know all of us here are brave enough to even do this thing without coming to this review. That's why most times I would say, nobody's teaching on anybody here. I'm just a moderator. I'm just a moderator. So because all of us are all the same. So we go ahead, ask questions so we can share opinions, share answers, and by then we help us to get the knowledge well, and that's what will help us to pass the exam. Most often what we say here may not necessary for the exam. It will help you for the business when you start. So when you start going the business, you see that most of the things that we'll be saying will be a repeat of what we have said here and making it the broad way so that you get it well to speak to your client or your customer. So everybody's welcome. So we're going to start from chapter 6, where we stop.
Sir, I have a question, please.
Go ahead.
Yeah, if it from the top, right? If you scroll all the way up,
Mhm.
after this, there's beside it there's exam 1 and other things.
All right.
Am I required to do all those things on the top on those columns?
You know, in this particular in all of them, all right, yeah, you have to do like any of the chapters you do, there's an exam below them.
No, I mean all the way up.
Oh, this one?
Yes,
exam
that one.
Yes, it's just, you can do it. You can do it. It's just to make you get several exams. We do it when we finish all the chapters. We normally do all the exams.
Okay.
We do the exam just to allow us to get more knowledge of what we are doing. Huh?
Okay.
Yeah, it's just to prepare yourself. It's good.
Okay.
You do it, yeah.
Thank you.
All right, yeah. So let's go to chapter 6. So you can read up from chapter 1 at least, or you spare time, read up chapter 1, then you meet us at chapter 6 as we are going. But for now, start with us on chapter 6. All right, so chapter 6 is life insurance premiums, proceeds, and beneficiaries. Of course, in the morning, I said there is no life insurance without a proceed. Most times, what we call the proceed is the benefit. Benefit comes in different ways. If you have health insurance, you have benefits. If you have life insurance, you have benefits. But the difference between the health insurance and life insurance benefits is that life insurance benefits is involved with money. Health insurance benefit is the care you received. And generally, there's nothing you can do in America today without insurance. Whether you like it, you take it, or you like it, you leave it. After all, that's why they say life insurance contract is a contract of adhesion. You take it or you leave it. So mostly in life insurance, insurance business, the insurance company, after writing the contract, they're not going to ask you your opinion. And they won't come and beg you to come and buy policy. No. No. They write a contract, they keep it there. If you like, come. If you don't like, don't come. However, in auto insurance, you are mandated to have life insurance. Everybody who is driving today is mandated by law to have, health insurance. Why do they do that? Because one, they want to protect people who is on the road. Two, they want to protect the cars, the people, the manufacturers of a car. They want to protect them. They want to protect the car. Then you buy a home. They mandate you that you must have life insurance, mortgage insurance before you live in that home. Even if you are closing a home today, if you don't have mortgage insurance, you will not close that home. Why do they do that? They want to protect themselves to make sure their money is not in the West. If anything happens to the home, what happened? They get their money back. If you stay, you couldn't pay your mortgage, what happened? They come and get your house and get their money back. So they always do things to make sure they don't lose. Now it comes to us. They are using us as a tool to make sure they don't lose. That is the basic truth. Whether everybody like it or not, that's the basic truth. Now it comes to it, you that are being used to buy a car. If you buy a car from a car lot, you must have auto insurance before you drive the car out of their lot. You buy a home, you are forced to get home insurance. You buy, you are forced equally to have auto insurance when you are driving. Anything, most of the things we buy, you must have insurance. You go to Walmart, you buy something, they ask you whether you want to put insurance on it. So now you, who is buying the home and putting insurance before you live in the home, buy a car and put insurance before you drive after the car lot, go to Walmart and buy things, they tell you want to put insurance, you put insurance. Even your phone has one. It becomes difficult for us to think, are we not supposed to have life insurance on our life? Are we not? In fact, let me tell you guys one story today. Somebody called me, that was last 2 weeks. The husband fell and had hemorrhage. So he was taken to hospital. And along the line, he had a surgery, several surgeries. Today, I speak to the person, and they said another surgery was done today. So it's now become a situation whether the man will survive or not, because already 3 surgeries have been done. One thing came to my mind, which I asked, did he have any insurance? The woman said, not that I think of. So imagine that this man is the breadwinner of the home. Just let's us just remove sentiment. Imagine, let's assume the wife is not working. Let's assume the man pays for the mortgage. The man feeds the family. What do you think will happen to all of them? Can anybody answer us? What do you think will happen?
They will be in crisis.
Crisis is understatement. Crisis will be understatement, because this wife now will not be thinking about losing the husband, which is not an easy thing that any woman want to hear. This woman will not be thinking about the husband again. This woman will be thinking, where is she going to live with the children? How is she going to get money to pay mortgage? How is she going to do that? How is she going to do this? And all right, turn it upside down. Let's assume what happened now happened to the wife, and the man is relying on the wife to feed. What is the same issue will happen? So it takes all of us to begin to speak before everybody will now understand what we're saying. It's not a question of whether you have money or you don't have money. That is far from it. It's a question of, are you committed to do, even if no matter how small it is. Nobody's telling you to go and do the one we cannot. No matter how small. All right, if you cannot do LTC, which is long-term care. So that when you reach at this situation now, the man is, because the woman cannot take care of him alone. He needs a good care. So what it means is that this man may not be in his home. But if he has a good policies, this man will be in his home. They will bring somebody to take care of him. That's the truth until when he joined the ancestors. So there's a lot of things that we should consider. Is important that we consider them. But some of our people in our community, when you're talking to them, they will do as if they don't hear. They will say, I got it all. They don't get nothing. They say, I have this, I have that. Nothing, they don't have any. All right, they may have. Like me, that I first have term life insurance, thinking that I have insurance. I have term life insurance. I thought that I have insurance. You see where I'll be bragging, say I have insurance. In those days, not now, because I can't even say it tonight. It becomes a story now. So some of them, they say they got it all. They don't get nothing. Some of them that have it, probably they have term in life insurance. When you begin to educate them, they will say, what have they done themselves? And let me tell you, tomorrow is late, today may be the best day to do it. So the reason why everybody is here is not only about you, it's about those your friends and well-wishers. It's about your children. In fact, you can struggle all those things and get all those money. Tomorrow they didn't see the person. The next day the money finished. That's the fact. So in as much as we are learning, we have to learn how to draw our children closer. It's difficult to do that. They say American children. My own not American children, and Nigerian children, now they call them, please. So you don't have to have that idea that because nobody will talk to you, nobody will whip you. Then my father whipped me, and I lived to be good. So not the American children, you must obey. So it's that discipline of how to manage finance must be passed to our children. It's very, very important because we suffer all this and finish, keep some of the weights that we can be able to keep. Tomorrow, if we didn't keep it to a good hand, it's just within some minutes it will go. Sometimes I used to say this, just most of us are from Africa. And in Africa, all of us, I'm not thinking anybody who was born in America that is here. I don't think. Except it's like Maria, you were born in America, I hope. So some of us who from Caribbeans and from Africa knows that most times people will be rich. At point in time, when those people die, their children cannot be able to hold tight as the person holding it when the person was alive. So in that way, some of the families, you go to there now, be like a deserted place. Nothing is there. Because what? That money then, there's no good management. So we wouldn't want it to be our portion. Now that we have entered into this race, everybody should join hand. It's a race. It's difficult, but yes, let's do it. It's something that somebody put on his mind that he will do. Is yes, nobody will do for you, do for yourself. Even if you don't want to do the business, please, for God's sake, get the knowledge. The knowledge will help you. The knowledge will help your surrounding. I'm telling you, by the time you finish this class, it did not even do the business. Your thinking will change, whether you like it or not. That's the truth. To change. You begin to think beyond what you are doing now. Because not be dead, everybody will die one day. That's the truth. But the circumstances surrounding it and those who live behind what happened to them is a factor that all of us must consider. So we're going to go to chapter 6. Chapter 6 is about life insurance premium proceed and beneficiary. I said in every life insurance, in every policy, in fact, in every insurance, there's always a proceed. Is the proceeds coming as a cash or is the proceeds coming as a care? In health insurance, the proceeds come as in care, which is the benefit. In life insurance, the proceeds or the benefit come as in cash, money. So now you see the difference. Because it involves money, the proceeds that involves money, there's a lot of intricacies you have to bypass before you can be able to get the money. It's not that you just get more, you just have policy. If you didn't do it right, when it reaches the time to get a claim, you see that it becomes difficult. For instance, if you don't have insurable interest on somebody and the person passed, it'll be difficult for you to get the proceed, which is the benefit. So all those are what we're going to educate our people, the importance of life insurance, the two types of life insurance, and the several policies attached to each life insurance. So that's also difficult, so important thing to do. Another issue we have been discussing is the beneficiary. I think we are going to start from beneficiary this evening. Beneficiary is in two types. That person who will collect the proceeds if the insured dies. I know whenever you hear insured, for those who just came today, the insured is that person who the policy was bought on his behalf. The policy owner is the person who buys the insurance. The policy owner can be the insured, but sometimes the insured may not be the policy owner. I used to say that, and that's the right thing. The policy owner can be the insured, but the insured cannot be the policy, may not be the policy owner. For the policy owner to be the insured means that you, as a person, you are buying the policy and you are insured. You are paying the premium, you are insured. So you are the policy owner, you are also the insured. Then when you buy policy for your child, for your mother, for your brother, for your sister, for your cousins, nephews, or your in-laws, all of them, you are what? The policy owner, because you pay the premium and they are the insured. So you can see at this instant that the policy owner is not the insured. But previously, the policy owner was the insured because you are the owner, you are the insured. When you buy for yourself, you are the policy owner, you are the insured. So we always said the policy owner can be the insured, and sometimes may not be the insured. All right. So we're going to check on the beneficiary. Who are these beneficiaries? Whenever there is a policy, there's always that person designated to receive the benefit if the insured passes. So that is the beneficiary. This beneficiary can be anybody. If you're here in America, your beneficiary can be in Africa. Your beneficiary can be in Jamaica. It can be anywhere. It can be in Canada. It can be any of the European companies. It must not be that the beneficiary must be here. No. It can be anywhere in the world. If anything happens, definitely they will contact the person to pass the proceeds to the person. That's the truth. So beneficiaries have different types. Depends on what you want, how you want the money, who you want the money to pass to. The beneficiary can be primary beneficiary. That is the person that immediately, if the person passes, that is the first person to have the proceed, which is the benefit. Now, we have also the secondary beneficiary. This person is the next in line. The secondary beneficiary is also called the contingent beneficiary. The contingent beneficiary or secondary beneficiary, that beneficiary are the same. Now, if the first one, which is the primary, is not available or has passed, the contingent or the secondary beneficiary will come over to take the proceeds. We have again what we call the tertiary beneficiary, which means I'm talking about the three types of beneficiary now. The tertiary beneficiary, this person is dead in line. If the primary is not there, the secondary is not there, then the tertiary will come and get the proceed. But however, if the primary is alive, the secondary or contingent beneficiary and the tertiary beneficiary does not have any right to earn the benefit. The benefit will only go to the primary. Those contingent or secondary beneficiary and tertiary, two of them are just there in line. Where if anything happened to the first person, which is the primary, they will come over to get the beneficiary. But the worst part of it is the tertiary, the third person in line. If something happened to the primary, and something happened to the secondary or the contingent beneficiary, then the tertiary beneficiary will come over. And in these three types of beneficiary, we have two kinds of beneficiary. One is the person that if anything happens, if you can change him at any time.
Sorry, Engineer Bat. Good evening, sir. This is Amarachi. I don't know if you are showing what you are explaining or you are just...
No. We are trying to round up what we have done.
Okay, sorry. Okay.
So we're going back to we're just rounding up. So the primary benefit, the two kinds of beneficiary, we have the revocable and irrevocable. The revocable beneficiary is that person which you, the policy owner, the insured who had died, will do what? If can change at any time at your own way without his consent. You do anything you like. Now, if you decide to make those beneficiary an irrevocable, meaning what? they cannot, before you do anything on that policy, you have to get their consent. It's like you are somehow sharing the power with them. So we're going to start from beneficiary now. All right. So remember what we did in the morning? It's just a recap of what we did in the morning. So we're going to go and start from the beneficiary. Hopefully, we're going to finish this chapter 6 today. I think it has to go today. Chinonyema, I think we have to finish chapter 6 today, I hope.
Yeah, we have to.
We have to, because
Yeah.
we have to finish chapter 6 today.
Mm.
We have done it 3 days. We're not supposed to be here. So we're going to do the beneficiary quick. Already, what I said now is what it is. That's what beneficiary is. If there's any other thing we need to know on it, we can easily go through it and know it before we continue. So, one thing again I want everybody to know is that beneficiary is not part of the contract. I want everybody to know that. What it means is this. Somebody can write his policy without the beneficiary. Or you can decide not to make somebody a beneficiary. If anything happens, the proceeds will go, or the benefit will go to their estate. Of course. So they're not going to force you to have a beneficiary. Sorry, please. All right. So we're gonna go through. So what I'm saying is that beneficiary, it's not compulsory that you have beneficiary. They're not part of the contract. The beneficiary is not part of the contract, which means they don't have any right on the policy. It's just somebody bring to say, if anything happened to me, collect the money. He doesn't have a right on the contract. He's not recognized to be part of the contract, no. So people can, if you don't have anybody, anything can be a beneficiary. Even some people use their dog as their beneficiary. Some people don't have any beneficiary. They leave it to go to the estate so that the state will go to probate court after paying all their bills. What happened? The remaining will go to the state. So anybody, you can even decide to any non-governmental organization to be a beneficiary. You can even decide your community, in your village, in your town. You can give your country, like as now, I'm from Nigeria, our country needs some money. Somebody can give Nigeria, my country, to be the beneficiary. So anybody can be a beneficiary. That grandma in the village, that grandpa in the village, that brother, sister, wherever they are located, can be a beneficiary. So please don't fear. But only thing which you have said before, and we continue to say it, even we see it today, was issue of using a minor as a beneficiary. Consider that and make sure you put somebody who is an adult. So let's look at the beneficiary. We are starting from here, changing a beneficiary, which I have said you have the right to do that. If a policy owner wants to change the beneficiary, there are 2 standard methods. If you want to change the beneficiary, one is filing, which is recording method, and the 2 is endorsement method. That is, if you want to change your beneficiary. The filing method is what is the predominant method people use. People use it, requiring the policyholder to notify the insurer in writing of the desired change. I think, even nowadays, I know one lady that changed her own recently. He just log into his account and effect the change. So, but however, for example's sake, the filing method, recording method, and the endorsement method is the 2 ways to change a beneficiary. On the first one, which is the filing method, what you do is just notify the insurer. After changing it, you notify the insurer. Notify them of the time and the date you make the change. That is it. You have changes, which means you can decide to change a beneficiary at any day, at any time you will feel like. Now, the other one is the endorsement method, which you can use. So let's look at the 3 kinds of beneficiary the revocable and irrevocable. Already we have talked about the revocable. You see, this thing is not really you cramming the thing. You want to know what it means. You don't need to cram anything. You see how I was just talking about it? That's exactly what you need to know. You don't need to cram. You don't need to cram the definition. Know what it means. If you see it in the exam, you can be able to, on your own word, know what. That's exactly what you need. They don't require you to revocable beneficiary. Begin to define it. No. Know what it means in your heart. Know what it means by, in fact, not even looking at it, you know what it means. You know that revocable beneficiary is that beneficiary that you can change at any time. Is that beneficiary that you have right to do anything, that you don't need his or her consent to do anything on your policy. That's what you need to know. If you know it, that will help you. If you go to the exam, you see revocable beneficiary, you already know what it is. So in most cases, the beneficiary is revocable beneficiary, meaning the policy owner may change the beneficiary at any time by notifying the insurer. The revocable beneficiary may be changed or removed by the policy owner at any time without notifying or obtaining the beneficiary permission. So most often, that is the one people use, revocable. The one you can dismiss at any time. In fact, you get here annoyed, you can just remove his name. You can wake up from bed because he gets here annoyed, you remove it. I know of a lady, is from, it's not Mexican, that lady, it's not, I think it's a Mexican lady. The cousin, this is a real story. The lady, the woman has 3 children. And those 2 children, believe me, they're not taking care of their mom. They are not, they left the woman alone. They don't even visit the woman. Now, people can be something. They don't visit the woman. I'm telling you something I've seen. They don't visit the woman. So they don't know that this woman has, I think, 450,000 life insurance policy and is a index universal. You know, it's very most often rare for you to see those in the Mexican area, if not now that the teaching has been spreading to everybody. So they don't, the children are not aware of that. But however, they left their mom to die. I'm telling you, they don't go to her, they don't call her, the woman will be sick in the hospital, none of them will go and check her. Then there's this lady I saw in Best Buy. I saw the lady on Best Buy when I want to go and buy a laptop for my daughter. I was prospecting the lady. So fortunately, the lady has signed in with somebody. So I was prospecting her. I engaged her in a serious discussion. She couldn't tell me that she had been signed by somebody. Then we have to go to a coffee shop. I gave her an appointment, said, let's meet. My mind was just to get to prospect her. So we met at a coffee shop. We discussed. She didn't tell me that somebody had signed her. I now give her an appointment to come to our office, of which she did not come. So we somehow become friends. I will call her. She called me. So one day I said, no. I said, now is the time for you to sign in so they can start do what we are doing. You're going to benefit out of it. Because she knows a lot of people. She told me, oh, but she have signed with somebody. I said, when? She said, it's not a long time ago, but she don't want to tell me on time. Now she began to tell me her family story. That's when she told me about this lady. And behold, this lady is living with her right now as I'm talking with you. So this lady that works Best Buy has to go to the hospital. They discharge the woman. That woman is her aunt. They discharged her. She brought her to her home. She says she's living in one room, bedroom apartment. So she brought the lady at her home, and the lady has 2 sons. So what she do was to leave the bedroom for that woman. She and her sons are sleep at the parlor. So that woman sleep in the bed. So these people, she and the sons are sleeping at the parlor. Even up to today as I'm speaking to you. So one day, she had been taking good care of the woman, driving her to check up all of those things. You know what the woman did? The woman tell her to bring her computer. The lady doesn't know what the woman was doing. Say, bring. Say, can you log into search for Transamerica? The woman searched for Transamerica. She go to her, she said, give me this bag. The lady gave her the bag. She bring her login information, tell her to log in. She log in. The 2 children are beneficiary to that policy. She told her to remove them. I'm telling you that is revocable beneficiary. I'm trying to give you an example of revocable beneficiary. So the woman told the lady to remove her children. She removed them. He said she should add her name. He said, what? So he said, no. He said, add her name. The woman said she will not. She will not. The woman said she will not add her name. The children will continue to be the beneficiary. The woman began to cry. The lady said she will not add. The next day, the woman called somebody who come to see her. He told the person to bring the laptop, open the thing. She now add that lady name. The lady become the beneficiary. So that is revocable beneficiary. I just gave you a story of a revocable beneficiary. You can change it at will, at your own time, whenever you desire. Now, let's go to irrevocable beneficiary. Irrevocable beneficiary is such beneficiary you cannot change. You cannot do anything on it. Before you do it, you have to do what? Get the person's consent. An irrevocable beneficiary cannot be changed without the beneficiary written consent. So this person you bring to receive the benefit if you are no longer there, now you have to get his or her consent before you can do anything on the policy. Even if you want to take a loan from your policy, if you want to make any withdrawal, anything you want to do in that policy, you have to bring him or her or get his consent. If you decide today you want to assign the policy to another ownership, you still have to let him or her know. So that is irrevocable beneficiary. So it's left to you now to know which one you think that is best for you and which one you think that is best will be best for your client, based on the teaching you're going to provide to your client to help her or him make a sound decision. So that's the 2 types of beneficiary. The beneficiary are those men or women that are responsible to collect the death benefit if the insured dies. Any question on the 2? I know everybody here should know what it means.
No.
Any question? All right. So
yes, question.
All right, go ahead.
So the irrevocable, can it be reversed? Okay, if I decide I don't want to do it anymore, I want to reverse it back.
Whether it can be reversed, you have to get his or her consent. You understand what I mean? You still have to get his or her consent before you can reverse it. He or she has to allow you to reverse it. You have to get his consent. Anything you want to do on that policy, you have to get the person's consent. And do you think the person will agree? Huh? I don't think the person...
yeah, maybe not.
Say, you think the person will agree?
I don't... Huh? I guess not.
I don't think the person will agree. Because you have boxed yourself in, the person will not agree. So that's it. So the thing is that before you make any choice, you have to know the kind of choice you're making. So remember we are talking about the change in beneficiary, how you change your beneficiary. One is by filing, which is recorded. The other one is by endorsement. So the endorsement is used. When is it used? It's used when policy may be returned to the insurer, so the new beneficiary designation can be endorsed to the policy. So if you want to return the policy to the insurer, then you can use the endorsement method. Then you can now change it. So that question has come into play in endorsement, because now that you want to do what? You want to change the beneficiary totally, you got to get his consent. If he agrees, now you have to come to the insurance company to effect the change. Because now they're going to totally remove you from a revocable beneficiary to put you on revocable, if that's the next choice you make. Is that okay now? All right. So let's look at
Engineer Bat. Sorry, I want to tell my people that there's something I came across today when I was solving my problem. It has to do with this irrevocable change of beneficiary. In addition to what Engineer Bat said, there's something in irrevocable. You don't have, as the policy owner, you do not have freedom. You don't have freedom because there's somebody that's checkmating you against reckless spending.
Yeah, of course, is one of the benefits.
Because it came out in question I was solving today.
It's
So
one
that's
I think I even said it in the morning. It's part of the benefit. The benefit of having a irrevocable beneficiary is that there's this person who monitors, who will say no to anything, particularly when you want to make a withdrawal that's not useful. When you want to take a loan that is not useful, that person will ask, why did you want to take it? Why do you take it? So it helps to check you on the way you use your policy, more especially when it comes in terms of taking money out of the policy, if that policy is a policy with cash value. So I think that is one of the benefits. But somehow the benefit, the goodness, the disadvantage outweighs the advantage. But it's a good thing for someone to monitor you, to check you. It's a good to avoid financial recklessness. Yeah, it's wonderful. It's good. It's one of the advantages in case if you see it in exam. So let's look at the distribution by order of succession. Remember, before now, we go through the types of beneficiary, the list of where you talk about the primary, the secondary or the contingent beneficiary, and the tertiary beneficiary. So we're going to look at the cost of the way you can be, the order in which the benefit to reach them. So each level, whether primary, contingent, or tertiary, always include one or more persons. You can put one or more persons. You can put in fact, you can put your whole of your community, if you like, to be your beneficiary. You can put as number of people as you want. But however, remember, the benefits is equal to 100%. So on each of them you want to be your beneficiary, you have to assign a particular percentage of the money to them. If you like, you bring all your communities, you have to distribute 100% to 8 of them, which means if that money is 500,000, you can say this person take 10,000, this person take 20,000. You must have to distribute it in percentage so that when the time comes, the insurance company will not find it difficult to pay them, because each of the beneficiaries have to be paid based on the information you provided. So it's left to you now to distribute 100% between all the beneficiaries you have made choice of. So each level we split proceeds according to percentage designated by the policy owner. So it's you that make the choice. Whatever you decide is what we hold. This one is not the will. You say, oh, I write my will, let them share. No, this one you share it by yourself. So the policy owner may continue the succession by listing a 4th in line, 5th in line, and so on. You can do 70 line, 100 in line, as you like. In other words, there is no limit in the depth of succession. You see what they're saying? List anybody, if the whole community, if you like. So let's just take a closer look at the most common beneficiary levels: primary, contingent or secondary, now and tertiary. That is the 3 basic levels of beneficiary: primary, contingent or secondary, and the tertiary. These are the 3 basic levels of beneficiary. So between them, this is where you're going to assign your beneficiary to. So let's look at the primary. The primary is first in line, first in succession. Whatever happened to you, the primary have to come and take. It does not belong to any other person. The secondary is just there waiting for the primary to die. If the primary dies, the secondary will be next in line. However, remember, every proceed or benefit in life insurance is tax-free. It's income tax-free. They will not tax you, so it's income tax-free. So that's what you should know. Every proceed, the benefits is tax-free. So the primary is first in line. If anything happened to the insured, the primary is the first person to get. If you get all the communities there, and probably one of the community is the primary, he will get before every other person, except he is not alive. then the secondary will come. If the secondary is not alive, the tertiary will come. If the tertiary is not alive, the fourth in line, the fifth in line, the sixth in line will come. So that's how it is. So specifically requested as part of the contract per strips or required by law, the state or heads of deceased beneficiary will not receive any payment in this case. So D must be on succession, who comes first and who comes next. If you don't do it that way, then it's a chaos. Nobody will. The insurance company is not going to help you to do that. In fact, you do this even while you are filling the application. That's when you do it.
Yes, I want to ask a question on that. So does it mean that you must have more than one beneficiary?
It's left to you. When it comes to this, I told you beneficiary is not part of the contract. It's left to you to decide whether you want to have 2, you want to have 3, you want to have 4, you want to have 5. But for safety's sake, whatever we are doing, we consider safety. You understand? For safety's sake, you never know what will happen to that one beneficiary. For safety's sake, sometimes it's good to have contingent beneficiary. Or if you like, you can have up to tertiary beneficiary. They're not doing anything for you. They are right there, them there. It doesn't take anything from you. You're not gonna. The law did not say you tell them or you not tell them. It's left to you. It's your own personal decision to decide whether you want to take more than one, you want to take more than 2, more than 1, or you take more than 1. But however, for safety, because remember, let's assume it's one of the questions that you see in the exam. If the insured and the primary beneficiary had accident and 2 of them dies, if you have only one beneficiary, what do you think will happen to the proceed? Anybody?
Now, what did you say?
The estate.
Huh?
Will it go to the estate or the court?
You go to the estate.
Okay.
So, and when you go to the estate, where is he going again?
Court.
You go to the probate court. Yeah. So there's, you see, so you want to avoid that. That's why you want to do at least 2 beneficiaries. So that if anything happens, all this thing we are doing, nobody knows about what will happen the next day. So you want to do 2 beneficiaries, even 3 beneficiaries, not to spoil by putting 3 names there. So that if anything happens, the secondary will come in line. However, in one of the questions, which you must see in exam, let's look at this scenario. The policy owner, that is the insured, and the primary beneficiary, in that policy, let's assume Mr. John has $100,000 life insurance policy. And Mr. John has 2 of his sons, James and Jacob, as the beneficiary. John is the primary, and James is the second son is the contingent, which is the secondary. Now, Mr. John and the first beneficiary had a crash in aircraft, and 2 of them died. Now, the question you will see in the exam is this. Who of them died? There is this law, which we are going to see here. I don't want to say, we're going to see it here. They will ask you this question, say, look, since 2 of them involved in an accident, there is a law that we assume as if the primary beneficiary died before the secondary, before the insured. What that means is this. If it's assumed that the primary dies before the insured, then it's assumed again that the insured have assigned primary beneficiary to the secondary, so that secondary can collect the benefits. You're going to see it in the question, but we're going to go deep into it when we finish this, the levels of beneficiary, when we finish it.
So in this, Professor,
that you must see in the exam. Go ahead. You say what?
So in this case, the primary, you have to make sure the primary die, and the insured is still alive.
No, 2 of them have died.
But
2 of them had accident and died. But since 2 of them had the accident and died.
I got it now. I got it.
The secondary will not go and collect the beneficiary because he does the benefits. The secondary cannot get the benefits. So because of the law will assume that the primary dies first before the insured.
Yes.
so that the secondary can get the money, the benefit. In fact, you must know this is something you must see in the exam. Yes, you must know it's something you must see in the exam. So let's first look at we have talked about the primary. The primary will go there and get the benefit if anything happened to the insured. He is the first in line to get the benefit. And remember, the proceed from insurance benefit is what? Tax-free. Tax-free. So whoever the insured choose as the primary is the first person to collect the benefit. That's what you have to know here. So let's look at the secondary. Who is the secondary? The secondary is that person who is second in line to receive the death benefit if anything happened to the insured, like if the insured died. So, but the secondary, which is the contingent beneficiary, cannot go and collect the benefit if the primary is still alive. So, except the primary dies, and when the primary dies, by law, you have to assume as if the secondary, I mean, the insured died before the primary, before the secondary can be able to get the proceed. So the secondary is in line, second in line. He's received the death benefit if the primary has died. So getting one beneficiary, to me, is not ideal. It's good to make it up to 2 or 3. You never know what will happen. So the tertiary beneficiary is third in line. He is just there waiting. Tendency of the tertiary beneficiary getting the benefit is very, 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 very small, because the first line and second line is there. The first line is the primary beneficiary. The second line is the secondary or the contingent beneficiary. So sometimes if you see it as the contingent beneficiary, remember that it's the secondary or second in line beneficiary. So the tertiary beneficiary is that third person who is there waiting for anything to happen before he can, the proceed can reach him. However, the secondary, the primary cannot be there, and if anything happened to the insured, the primary cannot be there, and the insurance company will send message to the secondary or the tertiary to come and get the benefit. No. This secondary or contingent and tertiary are just sitting there waiting if anything happened to the beneficiary, the primary beneficiary. So now let's look at distribution by order of succession, which is what we just finished now, distribution by order of succession. Look at this example. It says, for example, Mary elects to name her husband, Brett, as a primary beneficiary for 50% of the policy proceed. She also names their son, Duke, as a primary beneficiary for 25% of proceed, and their daughter, Taylor, as another primary beneficiary for the remaining 25%, making it what? 100%. Additionally, Mary names each of her Duke's 4 children, Joe, Jack, Jen, and Janet, as a secondary beneficiary for 25% of the proceed. Finally, Mary names her favorite local charity as the tertiary beneficiary. So let us look at the following situation that could arise, assuming Mary does not update her policy. So you can see the scenario we are looking at now. Brett is her husband, is the primary beneficiary, dies before Mary. Who is Mary? Mary is the insured, but Brett, the primary beneficiary, has died before Mary. Let's look at the result. Then 100% of the policy proceed will go to the next primary beneficiary, which is Duke and Taylor. Remember, she has 3 primary beneficiaries. I hope you guys are following.
We are listening.
Yeah, the lady has 3 primary beneficiaries. And the first primary beneficiary dies, which is the husband. He dies. And however, he has already assigned 50% of the benefit to the husband. He dies. What happened? The proceeds have to be shared between the 2 other remaining primary beneficiaries, which are the sons, Duke and Taylor. So now, if Mary dies, what happened? The primary beneficiary were given equal amount because all of them are designated, this one 25, this one 25. Now 50, the person who has the 50, which the husband has died, So the 50% will come to the other two beneficiary, the primary beneficiary. So if Mary, who has the policy now, dies, what happened? That 50% have to be shared equally among the two remaining beneficiaries, making it 50-50% for each of the beneficiaries. That's their children. So know that scenario. Then let's look at this one. Brett and Duke, some of the primary beneficiaries died before Mary. Let's assume Brett and Duke, which Duke is Brett, the husband. Duke is who? The son. Died before Mary. Who is Mary? The person who have the policy. What will happen? Taylor, the second son, will receive 100% of the policy proceed upon Mary's death. Remember, Taylor is another primary beneficiary. Have the secondary beneficiary come? No, because
No.
we still have the primary beneficiary. They have to get it before the secondary will come. So go to another scenario. It said Mary's husband, which is Duke, and Brett, Mary's husband, Brett, and children, all primary beneficiary, passed before her. If all the primary beneficiary now dies before Mary, what do you think will happen? The secondary will step in. And who are the secondary? Duke's children, which are their grandchildren. And what's going to happen? Already Mary has assigned percentage to them. He has assigned percentage to them, 25% of the proceed to each of them. So the proceed will now be shared 25%, 25 to the 4 of their grandchildren. Now let's see another scenario. Brett, the husband, Duke, the child, Taylor, the child, Joe, the grandchild, which is the secondary, Jack, the grandchild, Jen, the grandchild, and Janet passed before Mary. Who is Mary? The person who have the policy, the insured, which means the primary and the contingent or secondary beneficiary all has passed, all have died before the insured. What will happen? Mary's favorite local charity will receive 100% of the policy proceeds upon her death. So, which is the tertiary. Immediately the primary, the secondary, all of them have passed. Who comes in? The tertiary. So that is just what you have to know on the beneficiary. Now let's look at the example. We say when dealing with order of succession questions, always assume the policy owner has not updated or may made any changes to the beneficiary unless these changes are explicitly included in the question. So know all the scenarios, definitely, you're going to see 1 or 2 questions from that. There's no two about it. So you will first questions from answers that are almost correct except if or except, and the most correct based on the included information. The best way to answer you, to ensure you are picking the most correct answer is to avoid interpreting or adding information to the question that was not included. What is he saying? Do not interpret the question based on your own knowledge. Allow the question to be the question asked and answer it based on the question asked. What the word you see there is what you're going to use to answer the question. There's no need to put your own word, put your own interpretation. When it's happening like this, don't say by your own understanding or by your based on what you know. Don't say, oh, why are they giving it to the Shari? Can't they give it to the grandchildren, children? No. Whatever that is written on the question is what you follow. So please note this order of succession. It's very, very important. Questions come out from there. So let's look at this distribution based on descent per capita or per strips. Broad seed shared among multiple beneficiaries by either a per capita or per strip distribution method. What is per strip? That is per
bloodline
head, which means what is per capita? Per head or per person. That's what the proceeds have been distributed to. So distribute benefit among all named living beneficiaries. Typically, the surviving children if all children beneficiaries have died before the insured, the proceeds are divided between all contingent beneficiaries per capita as the distribution method that will be used, unless the policy owner specify per strip method. So you have to know this. Just a scenario we have said now. Let's assume everybody dies there. both the contingent and the primary has died. I mean, the contingent and primary, which is the contingent, which is the secondary and the primary has died. What happens? The benefit has to go to be distributed to the per capita to the contingent beneficiary. Of course, the percentage of to be given to the contingent beneficiary, the tertiary beneficiary, the percentage was not known. Assume in the tertiary beneficiary, they have up to 4 people. You have to distribute it per capita, per head, which means since it is 100%, you have to share it among them. Because what? The insured do not include the percentage to be assigned to them. So that's one thing. That's per capita. Then per strip. Per strip is what? By the bloodline, which is that interpretation most of us will give to this kind of question. So, why not probably the grandchildren must have children? We'll give it to them instead of giving it to the person named. No, do not take it that way. Do not put a word on the questions. Do it exactly what you see on the question. So, per strip makes distribution according to family line, branch or roots, children and grandchildren. If a beneficiary dies before the insured, no changes are made to the policy. If a beneficiary dies before the insured and no changes are made to the policy, benefit from that policy will be paid equally to that deceased beneficiary's heirs. Because of this, it is not necessary to name contingent beneficiary. So, is another way, if you don't have a contingent beneficiary, what they're telling you per strips is that immediately the person dies, they will look at next line on the family and give the person the benefit. But however, that's from this discussion, they said you may not name the contingent beneficiary. So if such a thing happens, the family will get it. But to be safe and to direct the proceed where you want it, it's good to name the contingent beneficiary. Otherwise, they will look at the person that is in the family and give it to him. Most especially for us who are immigrants. If you're here, probably you have only your people down in your country, and you do not name the beneficiary. They may call the wrong person. The wrong person may collect the proceeds. So I think, to me, I believe it's best to have them. So distribution based by descent or scenario. So as we are learning, per capita is the default distribution method unless the policy owner requests per strip. Let's see how Mary's example plays out if she had elected per strip. So let's assume Mary has elected per strip. It's just the same thing we did before. Let's assume Mary has elected the way to distribute it by per strip. What will happen here? Duke and Taylor are Brett's only heirs, which are the children. Taylor gave birth to the daughter named Kim prior of Mary's death, and Mary did not make any update to her policy. So he has already distributed the benefit, and before he dies, he did not make any changes. However, Taylor gave birth to a daughter named Kim before Mary died, and before Mary died, Mary did not make any update based on who will be the beneficiary. However, he has the Duke and Taylor as a heir to Brett. Brett is the husband. So now let's look at the scenario that will play out here. Oh, this one's so long. So let's assume Brett dies before Mary. Who is Brett? The husband. 100% of the proceeds, and the husband is the primary beneficiary, I hope you know, which he has 50%. Now the children has 25%. So if Brett dies, which is the primary beneficiary, the first primary beneficiary that has 50%, what will happen? 100% of the policy proceed will be split between Duke and Taylor. Duke and Taylor is their sons. Upon Mary's death, since they are the remaining primary beneficiary, and they were assigned equal amount. Since they are assigned equal amount, the money will be distributed to them. That's what we call pay capital. Pay capital. It happens. It was not written, but because they are beneficiary and they were assigned equal benefit. Now, what happened to the 50 that Brett left before he died? What happened? They now insurance company have to now share it between the two primary beneficiaries. Now, let's look at what happened at per strip result. 100% of the policy proceeds will be split between Duke and Taylor, which is 50-50%. Duke 50%, which is 25 as non-beneficial and 25 as Brett Hare. Taylor 50%, 25 as non-beneficial and 25 as Brett Hare. Looking at it, you will see that all of them are the same, both per strip and per capita seems to be the same thing. So let's go down and look at it. It said Brett and Duke died before Mary. Who is Brett and Duke? Brett is the husband, Duke is the son. Two of them died before Mary. What will happen? Taylor will receive 100% of the policy proceeds upon Mary's death. Policy proceeds are split between Duke's children and Taylor. That is per strip. Per strip now, instead of Taylor getting the whole thing, that Taylor can get the whole thing as per capita. Then per strip, Taylor is not going to get the whole thing. So the money, the proceeds are split between what? Duke's children and Taylor, which means some of the money will go to Duke's children. Remember, Duke and Taylor are the same mother and father. But Taylor dies and the Dukes are still there. So the proceeds, Duke will not take it alone. Duke has to share the money between himself and the children of Taylor. That's what per strip result. But per capita, Taylor will get all the money. Per strips, all the money will not go to Taylor. Some of them had to go to Taylor's brother, which is Duke. Duke and the children. Duke's children, sorry. So I hope everybody is following. It looks confusing, but you get it, you get it. So Duke's children, again, Duke's children, 50% combined to 2.2%. So what happened here? Let's all now continue to read. They have to distribute for per strip. All the people in the family will be involved. That is per strip. Whether you name them or not, because you choose per strip, everybody will be involved. They have to make sure the distribution reach each and every one of them. While in per capita, that beneficial, as far as he's still there, is one person who got the whole thing. So you can see why strip may be good, and again, per capita may be good, depending on what you want. So all this depends on what your client wants. Everybody's own differs. What I need is one may not be what you want. What you want may not be what I want. So based on education provided, that person can make an informed decision. So that's why it's necessary for all of us should be able to understand this. If you know it, when you are teaching anybody, you give the person a good information so the person can make informed decision. I continue to say that previously, when people are writing policy, I use myself as an example. When I bought my first policy, I did not know anything about life insurance. In fact, my colleagues in the office were laughing at me when I bought it. They said, but do you want to die? I said, if I die now, after all, everybody will die one day. I said, if I die now, let my children, my wife get that. That's my notion. That's what I had know in mind then. When I bought the first policy I have. Then 2007. 2007. How much was I making? I don't think I'm making up to $900 every week. I don't think so. But it now become a question of mindset. You can see why it's necessary for you. For you, that is, if you are here, you don't have your policy, please go back to the person who bring it to this business. Make sure you have, no matter how small it is, cover your children. Those children are more precious. Cover them. Cover them now that they don't have bad record in their no medical record that will prevent them from being covered. It may be difficult, but believe in me, if you design it the way you want it, what it means that some of the things you are doing that are not necessary, those things have to stop. For instance, every time Amazon come to your house, every time you are going for Owambe, you wear this gown today, tomorrow you send him another hair tie to buy, another cloth to wear. By the time you begin to know that you have seen something better, you're gonna stop on. Let me leak one secret for you guys. My wife doesn't belong to Owambe. My wife doesn't belong to Owambe again. She doesn't go to others.
She's busy.
No. It's not a question of busy. She have known the value. If you know her before, because of course she's well known, Everywhere, everybody, everywhere they do know Ashebi, they must send her. Oh, it's like probably I will snap the thing and show you guys one day. Because now we are telling ourselves the truth. If you see the hip of her tie, if you see the hip of her tie, some of them, you have not worn it for once. You see the hip of clothes, they will sew it now, they go today, tomorrow, they will not wear it again. No, I'm telling you, but all those things, not her. She used that money to go pay one of her policy. So it's not a question of money, it's a question of your mindset. If you know that this is important to your family, you're going to make a way to have one. That's just the truth. Your children, even if it's 50,000, remember, the earlier the better. If those children that are so small, you write policy for them now, you pay less now than when you write in the next day. And again, remember, slightest thing they may be denied. So do it now that they are see no result is there. Even you, now that you don't have any medical issue, remember, there's no way you can reach up to 80 years. There's no way you can reach up to 60 years, 50, 55. You don't have any medical issue. That is the truth. If you see anyone who doesn't have any medical issue, even if it may be hypertension, or maybe the blood sugar, or maybe cholesterol, maybe so many things. So this is the right time. Do it. Even if you have any medical issue, put an application. You don't pay money to put an application. If they don't approve you, you know that they don't approve you. If they approve you, you thank your God. Do as little as you can. But not doing at all is the worst. So let's look at distribution to an estate. Remember, if you do not have a beneficiary, what happened to your money or the benefit? The benefit will go to an estate. So a policy owner must list all desired beneficiaries and update the destination as needed. The policy proceeds will be paid to the insured estate if none of the listed beneficiaries are still alive at the time of the insured's death. Or if the beneficiary does not have any, if the insured does not have any beneficiary, the money will be paid to the insured estate. And when you go to the estate, what do you think will happen? Probate court will set in. And if you don't have any beneficiary, what happened to the money? Probate court set in, they pay all your estate, pay all your bills, the remaining one will go to the state. So benefits paid to an estate are subject to possible federal and state estate debt taxes, as well as probate fees, before being passed on to any other person. We look at one thing. For most of us who do not, maybe have not understood this, not that only that the money is going to probate, you're going to pay estate tax, which is death tax. You do know that somebody who died pays most of all we know that you pay tax when you're alive, you still pay tax when the person died. I hope most of us doesn't know that. You pay tax, of course, you pay tax when you're alive. Everybody's filing tax now, or tax season. This is tax season. Everybody who's living in America file tax, which means you pay tax. You pay tax as a living being. You pay tax also in debt. So if you nobody to collect the benefit, what happened? The benefit will go to what? To your estate. If you go to your estate, then there is possible federal and state tax, estate tax. Estate was what? Debt. Those bills are called what? Bills while you're alive, and they become estate when the person passes. So there is what we call estate tax, which is death tax. So as you are alive, you pay tax. Even when the person dies, the person pay tax. So if nothing goes to the estate, what do you think? Where would they get the estate tax? They will not see anywhere to get the estate tax. But if that money goes to your estate, there must be estate tax, which is death tax, and as well as probate fees. So not as the estate is going to probate court for distribution, because the reason of going to probate court is for distribution. You're also going to pay from that money, pay estate tax, you're equally going to pay probate fees. So the court, the judge who is going through the process it must be paid. And who pays it? You. So there's need to have a contingent. There's need to have beneficiary in everything you have to avoid going to probate, going to your estate to probate, where you pay estate tax. By then the person will be inside the ground. The person may be decaying. The person is on the ground inside, and the person is paying tax for those who are living. You're paying estate or death tax, and they call it probate court, who is going through your bills and paying all your bills while you are alive, is what? Collecting probate fees. So this is what we are trying to let everybody understand and avoid that. So additionally, creditors may have a right to fund in all estates. Of course, therefore, a right to the proceeds of a life insurance policy paid to an estate. So you try to avoid any of your thing going to an estate, because what? Probate cost sitting, you're going to pay probate fees. You have to pay debt or estate fee, tax. Upon that, there are creditors, those who we have owing, the student loan you are owing, the hospital that treated the person before the person passes, the nurses, all those people, they have to bring their bills. Even the car that took the person from the hospital to the morgue, all those things are there. Those who clean the person up in the morgue, all those people must be paid. And where it's coming from is from your estate. So these are the things you have to know. So we're going to look at, we're not going to look at the example. We have already discussed the example. Let's look at distribution to a minor. Now you decide to have a minor as a beneficiary. Let's look at what will happen. A life insurance company typically will not pay policy proceeds directly to a minor beneficiary. So for those who think their minor child will be the beneficiary, life insurance company will not pay policy proceeds, death benefit proceeds directly to a minor beneficiary. No. What they will do, although any entity can be what? Named as a beneficiary, many states don't permit proceeds to be paid to a minor because they lack the legal capacity. So there's no question again whether I put my child who is underage, minor. No, they lack legal capacity. So they cannot make a decision that is well informed. Based on that, you will not put them as a beneficiary. And even if you put them, what happened? Life insurance company will not pay them any benefit.
I have a question, sir.
Go ahead.
So during the exam, if a question like this comes out, should we just assume that it is the general one if it does not fall into the state exam section?
Yeah, this is general.
So we use a general age for underage, which is like under 10. Okay, all right.
Yeah, age of maturity. Age of maturity. I think New York is 14 and a half years old. Who is from New York here? Who is from New York?
Me.
New York, what's the age of maturity?
Marie, 14 and a half.
14 and a half. So New York is 14 and a half. So a minor will be below 14 and a half at New York. So I know Texas is 18 years. So other states have their different, but assume you are seeing this in the national part of the exam and they did not specifically mention the age. I think here they talk about 16 years as the maturity age. The different states have their own. Here they say 15 to 16 years. They did not mention the particular age they want at the national. They say 15 to 16 years. That's what they say. They now make reference to New York that has 14 and a half years. So if they did not mention the specific age, just between 15 to 16 for national, then your state should have their own. Texas is 18 years. So check your state. Like Mariam said, her own is 14 and a half years. That is for New York. So if you are from New York, it's 14 and a half years. Any other state has their own age of maturity. Please just find out so it will help you.
No, sir, I have a question. I'm so sorry. I want to draw you back a little bit.
No, go ahead. You are free.
Yeah, the estate you are talking about, and I don't think I joined when maybe you guys did something on estate. I'm like a bit confused. Is it like the literal meaning of estate, or does it mean any other thing in insurance?
So, all right. What do you understand by estate? Or your own word? Just say it. Anything what you know about it.
Okay, estate literally means your assets you have.
All right. You see, I told you that they're gonna put their hand on your head. When they put their hand on your head, you fall as they are falling at the church. So there are a lot of people to raise you up. No. So no. The estate you have in not in mortgages, your properties, no. Not real estate.
Okay.
When somebody's alive, all what you have is called what? Bills. All what you have, mortgage bill, electric bill, I have a bill to pay. All the things you owe people is what we call bill. When the person pass, they call it an estate. Those bills now is called an estate.
So including loans and every other.
Yes, all of them.
Okay.
All of them. So if the person pass, maybe the person died, something like that, then all those things now become an estate.
An estate.
So what they do to that estate, they bring both anything, any cash you have, even the cash you have at the bank, will come to that estate. The bills, the state loan you are owing will come to that estate. Everything you have will come to that estate. Now they will push all of them to probate court. The probate court will now do the distribution. They will ask the loan people how much Mr. Peter is owing. They say, oh, he's owing us $100,000. They will come out money from the money you have and pay the student loan people. They ask your auto insurance how much John is owing. They say John is owing us $10,000. They bring out money from the death benefit and what? Pay them. They ask all of it, AT&T, I had John owes you $500. AT&T say yes. They bring out $500 for AT&T. Pay to AT&T. Oh, the hospital that treated John, how much is he owing? They will talk. They pay John. So by the time they pay all those things, they now pay probate fee. They now pay estate tax. They pay all those things. What happened? The remaining one will now be sent to your beneficiary, who may be your wife or your husband or the children. You can see how dangerous it is.
Wow.
You can see how dangerous it is. So most of us does not know that that's what happens. Most of us does not know that's what happens. Until when it happened to one person, now that's closer to you, you'll be saying, wow, wow. Do you know that if somebody dies, immediately the person passes and they made that call, which nurses, if you're a nurse, you understand what I mean? They made that call, which normally the nurses do. From that moment on, you cannot access that person's bank account. Do you know that?
Yeah, I said that today. I heard about it today. I never knew that before.
All right. So the bank will lock up everything. You cannot access the person's account. So once you cannot access that person's account, that account, after everything, that account is going to the person's estate. It's going to the probate court. They're going to use every money there in settlement of the debt of the estate, in settlement of everything, pay taxes and both the one at death and the one living and all the probate fees. They pay all those. The remaining one, they will not give you the family of the person who died.
If he remains.
If he thank God if he remains, yeah, they will give it to you. So we have seen why minors are not allowed, not that they are not allowed, minors are not advised to be in our what? In the beneficiary. If you decide to keep them, they do not have any legal capacity to make decisions, which means insurance company will not give them the benefits, of course. So, however, how can you bypass that? In addition, minors potentially not being competent to handle a large sum of money. You see, Americans will give you reason for everything. No, apart from they don't have a legal capacity to do that. The life insurance has clauses and provision that try to protect the customers. In as much as the insurance company are there, they still have provisions that try to protect their customers. So in case the insurance company want to maltreat, want to do anything that's not good, no, they have clauses and provisions that will protect you. So you see why they are doing this, that minors are not considered to have legal capacity. Apart from that, they're saying minors are not competent to handle a large sum of money. Are they going to say this on health insurance? Of course, no. Because life insurance benefit is involved in cash. Health insurance benefit is care. So they're not going to say this on health insurance. They're not going to say this on health insurance. After all, look at Social Security. If a father or mother, parents die today, the Social Security benefit can be passed to their children, whether they are minor or not. Yes, but can it go there? Can it go like that on life insurance? No, because this one involves money, involves cash. They told you that minors don't have a legal capacity. Apart from that, they are trying to tell you equally that that minor does not have the competence to handle a large sum of money. So you can see, a minor may not be able to receive the payment and return a receipt in a legitimate manner. You see all the reasons they are giving you. So for this reason, a guardian or a trustee will be typically appointed to manage the estate. The money has entered the estate too. So they're going to appoint somebody, a guardian or a trustee, to manage the money. Do you think the guardian or the trustee will work without being paid? Anybody? Do you think they will work without being paid? They will manage the money without being paid? I don't think so. If that is your job, are you not going to pay your bill? So they pay, those managers will be paid. And when they pay, where is the money coming from? From the death benefit. So what is going to happen? The man will not even like to miss his job. He would like to manage the stint to up to 20 years to make sure in the job he continues to get his money free. So in some cases, an insurance company may hold the proceeds and pay interest on them until the beneficiary reaches the age of maturity, which means the age of maturity is what we said. Find out from your state the age of maturity. So if the insurance company decide to keep the proceeds, they continue to pay interest to the person until what happened until the person reached age of maturity. So, but why do you want to go through all these things? It does not need to go through all these issues. So, distribution to a trust. So, apart from human being a beneficiary, apart from non-governmental organization being a beneficiary, you can still use your trust to be a beneficiary. You can name your trust as a beneficiary. So, if anything happens, the proceeds will go to your trust. So, of course, you are going to name a trust as the beneficiary. It's the most advantageous way you can distribute the benefit. If you're a policy owner, you want to leave a policy proceed to a minor child, this may be the best way for you to do. Put it in a trust. In this case, a trustee will manage the trust for the benefit of the child or children. However, trust administration fees may reduce policy proceeds. So even look at it, it becomes even more dangerous. Although putting a trust is the best way, if you don't have, you still have to appoint who will manage the trust. If you have an adult in your home, the adult can manage the trust. But if you leave it to the trustee, who will be a manager of, you don't know, you still have to pay the person. You have to pay fees based on that. And before you know it, that proceed money will reduce. So two forms of trustee are testamentary and inter vivos trust. So trust is another issue we're going to look at. It's good. Put all your their earnings, all your assets to trust. That will help you. You're not going to appoint people who will come and manage the trust and make money out of you. You can appoint any of your child or any of your brothers or sisters to be the trustee. There is no special certificate to be the trustee. Trustee is that person you appoint. It can be anybody you appoint. As far as that person is of age and that person is competent enough to handle it, that person can handle the trust. So if a testamentary trust is created at the time of insured death. The two kinds of trust we have is testamentary trust. This one is created when the insured died, as specified in their will, an inter vivos living trust is created during the life of the insured. So vivos living, which is a living trust, the trust you created. So now that all of us are here, if you decide to go and create a trust, it's called what? Living trust or vivos trust. But if the person passes, the now trust is created, is what's called testamentary trust. So please know that in case if you see it. So we have two types of trust: testamentary trust, which is created when the person insured died, and living trust or vivos trust. That one is created when the person is alive. So any of us can create a living trust. Testamentary is when the person has passed. So we have facility of payment provision. This is what a provision permits an insurer to pay a portion or all of the policy proceeds to any individual who appears to be equitable in title. Such payment may be provided to party who paid for the medical or final expenses of the insured who has died. So this facility of payment comes to the issue of some people who are caregivers. I know of a lady that is a caregiver, and he was taking care of one man. So the man have to put him as a beneficiary of one of his policy. So when the man passed, what happened? The policy proceeds went to the lady who was the caregiver then. So this kind of thing is not start from the beginning. It's just something that happened due to a care provided. So that's the facility of payment. Now let's move on. We're going to move ahead. Uniform Simultaneous Death Act or Common Disaster Provision. So this is just the story I said before, which I say is a law that if two persons, the insured and the primary beneficiary, died in accident, when you don't know who is the first person that died, by the Uniform Simultaneous Death Act and the Common Disaster Provision, what happened is this: they will assume by this act that the primary dies before the insured, so that it's like assume again that the insured has changed the benefit to the secondary, so that the secondary will now collect the proceed. So when the primary and the insured died at the same time, actually we don't know who first died. Let's assume in plane crash, do we don't know who first died? No. Everybody died. They died at the plane crash, and possibly two of them died at the same time. But you wouldn't know who first died. But by this act, it is for this purpose, so that the secondary will collect, it will be assumed that what? That the primary, the insured died before the primary, so as to give the secondary the opportunity to collect the proceed. So Uniform Stimulus Death Act and the Common Disaster Provision, that's the two things we're going to do now. How a policy responds to common disaster death is governed by the Uniform Stimulus Death Act. How policies respond to common disaster deaths when two people die at the same time. It is stated that if the insured and the primary beneficiary both died in a common disaster, e.g. a plane crash, and it cannot be determined who died first, the insured will be considered to have survived the primary beneficiary or died last. In other words, the primary beneficiary will be considered to have died before the insured. Therefore, the first amount is paid to the contingent beneficiary. So know this. Everyone knows this, please. This is one of the questions you must see in the exam. They like to ask this question well, because they want to know whether you know how the proceed or the death benefit will be distributed. So Uniform Stimulus Death Act is what explains us this. Because of this act, that two assumptions, one, two of them died at the same time, it's assumed that the primary died before the insured. Now, why is it assumed that again the insured may have transferred the first primary beneficiary to the secondaries or the contingent? And what happened when it's transferred? Then the secondary or the contingent will collect the benefits. So any question on this? on Uniform Stimulus Death Act. Any question? Any question? All right. So at least everybody here knows it. The primary beneficiary clearly died first, and then the insured died. The benefits are payable directly to the contingent beneficiary. So that's what I want everyone to know. The common disaster provision further clarified this complex situation by adding a survivorship. So we have done the first one, which is called the Uniform Stimulus Death Act, which we said that is assumed that the primary died before the secondary so that the contingent or the secondary beneficiary can get the benefit. That is by Uniform Stimulus Death Act, it means that assumed that the primary, who is the primary beneficiary, died before the insured. However, the insured and the primary are involved in accident. By this Death Act or Stimulus Death Act, it's assumed that the primary beneficiary died first before the insured. And what does it give us? It now gives the secondary beneficiary the opportunity to get the death benefits. So that's what you have to know. Now, let's go to the common disaster provision. Of course, we have known that if the insured died first, the death benefit is payable to the primary beneficiary. In the normal way, if the insured has a primary and secondary beneficiary and the insured died first, what will happen? The beneficiary will, the benefit will go to the first, the primary beneficiary. Is that not the truth? That is the truth. That's what all of us know. That's exactly what all of us know. That if there is an insured has a policy and he died, the benefit will go to the primary beneficiary. That is what all of us know. The common disaster provision further clarified this complex situation by adding a survivorship clause, a time delay feature. So this clause requires that the primary beneficiary not only survive longer, but also outlive the insured for a specified period, typically 14 to 30 days. The common disaster provision guarantees that if both the insured and the primary beneficiary died within the certain period, the death benefit will be paid to the contingent beneficiary. Benefit will only be paid to the primary beneficiary instead if the primary beneficiary lives past the required period. So, which cannot happen. Which cannot happen. So let's move. Uniform, we have talked about this. We're not going to go there. It's an example. So tax consequences of a life insurance. The tax consequence. Do life insurance have tax? I thought you said it's tax-free. Of course, it's tax-free. But we're going to see the tax consequences. Remember, in anything we do, there is always tax. You cannot run away from tax. So tax treatment of individual life insurance premium. How our premium being treated as far as tax is concerned. That's what we're going to see. So according to Internal Revenue Code, premium paid for individual life insurance policy are considered a personal expense. And as such, are not tax deductible. You do not pay the premium is not taxed. And that is why when you pay your premium, your life insurance proceeds are not equally taxed. Because the money you use to pay for the policy has already been taxed before you pay it. Now, do you think if there's any proceed from what you have paid, the proceed will be taxed? So just before a premium used to purchase a life insurance on a spouse or a third-party ownership situation doesn't mean that the premium will be tax deductible. No. Premium paid on life insurance may be tax deductible. For life insurance owned by a qualified charity to provide a control to the charity. All this, we're not going to read all this. So let's go. Tax consequences of life insurance, a profit deduction. We're not going to do this. Taxation of proceeds paid at death. Does death benefits, do you have to pay tax on death benefits? Of course, no. Since the premium paid are not tax deductible, they are paid after tax. Premium you used to pay for the policy is you paid it after tax. You go to your bank and withdraw money, or they pay you check you pay from your check. You already pay tax on that. So proceed used to pay, I mean, what you used to pay for the policy, your premium, you already pay tax on it. Therefore, the proceeds, which is the death benefit, will not be taxed. So that's why we say life insurance are tax-free. So the proceeds death benefit from the left life insurance policy are paid to the named beneficiary on tax-free basis, disbursed as a lump sum. An exception is to the rule is the transfer for value rule, which applies with life insurance policy is sold to another party before the insured's death. All right. The third party will now come out to bring us to that third party when you sell life insurance to another person. You know, some people buy life insurance as they buy goods. Some people, their business is to buy policies from people. I hope you guys know. Some people, their business is to buy policies. So if you have a policy you want to sell, there are some people can sell the policy to. Yes, their business is to buy policy. So when those people buy the policy and eventually the insured died, in which they will go and collect the benefit for their profit, they will be taxed. That's what this is starting to tell us. That was a taxation on proceeds paid on tax. When your businesses go and buy policy from people, you pay tax, you buy the policy, and eventually the person died. Because you bought the policy, you are doing it as a business. That tax-free benefit you see in policy is no longer in life insurance is no longer there because it's no longer the business insurance, it's now a business. So you have to pay tax on it. That's what it said. So economic benefits doctrine. We're gonna look at this. Taxation of cash value. I hope who doesn't know what cash value is? Who doesn't know what cash value is? Who doesn't know? I hope everybody knows what cash value is. So, yes, since all of us know what cash value is there any taxation in cash value? Who can answer us?
No, cash value?
Is there any taxation in cash value?
No. But there's taxation on the interest.
No. But
No.
the interest, as she said, is tax.
All right. What about our dividend?
It's tax-free.
No.
Dividend, is it tax?
No.
It's tax-free.
What about the interest?
It's tax.
Huh? When you see, did you remember how we can collect your dividend in a mutual company? Do you remember the 4 ways you can collect your dividend?
Through cash.
Go ahead. Through cash one. You can say the cash should give you the money.
Yeah.
I use it to pay our premium too, right?
Two, yes. Not again.
And then we can use it to buy another.
You can buy another policy.
The term policy. 3. What again?
Remember no.
And then you can let them use it pay like your premium so that the premium will reduce. Is that right?
Yeah, that is the third one. Remember the fourth one. So the fourth one.
Put it on as reserve.
The fourth one is you can accumulate it.
As reserve?
Okay. Yes, you can
put it as reserve.
Not as a reserve. No, not a reserve. You can accumulate. Oh, of course, you can call it reserve, but the right word is accumulation. You can accumulate the proceeds from your dividends. When you accumulate it, it's going to be yielding interest for you. So during the collection, when you want to collect that accumulation, you will collect the accumulation. But the interest on that accumulation, you have to pay tax on them. The interest that comes out of the accumulation, you have to pay tax on them. So that is the ways you can it can be taxed. But if you go to collect it as a cash, when the dividend comes to you, you collect it as a cash, you're not going to be taxed. If you use it to pay your premium, you're not going to be taxed. If you use it to buy more policies, buy term life policy, you will not be taxed. But if you decide to make money out of it by accumulating it, allowing it to accumulate, if they give it to you, you say, please save it for me. You accumulate it. When you want to collect the accumulation by them, it have been good, big enough, what are they going to do? The interest on that accumulation will be taxed. Do you understand? So that is another way policies can be taxed. I mean, life insurance proceeds can be taxed. So the total of the premium paid into the policy minus the total dividend received in cash or used to offset premium is referred to as the what? Cost basis. Under the cost recovery rule, if the policy is surrendered for its cash value, the portion that exceeds the cost basis or premium paid is treated as ordinary income and are taxable. So whenever you are talking, even the cash value you are talking about, if it's surrendered, if they do the cost recovery rule, use the cost recovery rule, any proceed from that cash value will be is taxable. They regard this as ordinary income and they will tax it. So, however, if the cash value remains in the policy, tax will never be imposed on any portion, not even the amount that exceeds the cost basis. Do you have it? But now, if you use it for another thing like doing another business, what happened? The proceeds thereof will be taxed. That is why in the dividend, the accumulation, if you use it to want to accumulate it, the interest on it is taxable. Is that clear to everybody?
Yeah.
All right. So let's look at taxation on policy loan. This is another thing you have to know, but however, you will know it more during presentation when you get your license. Some of this thing, you will see it practically when you begin to do the business. You will see it. They will teach you well on it, and which will be a criteria of you even to be promoted to one area or the other. Remember, I hope everybody remembered what we said about modified endowment contract, MEC. We discussed about MEC in the morning. So let's look at the taxation on policy loan. Ordinarily, you are allowed to take a loan from your policy and you use your cash value as a collateral. We said it in the morning. Cash value is a collateral that can allow you to get a loan from your policy. I hope everybody knows that. So you can go to your policy. If it has a cash value, you can go there to get a loan. Let's assume your cash value has $60,000 on it. That's what you have on your cash value, which is your collateral to take a loan. Now, you go and call the insurance company and you have a problem that what we solve that problem is probably $80,000. Now, you call the insurance company and say, look, you want to take a loan on your policy. They ask you, do you think you have any cash value? Of course, you have checked your policy. You say, yes, I have $60,000 as the cash value. They ask you, how much do you want to take from it? You say, oh, I want to take, can I get $80,000? That's their reply to the insurance company. However, you have only $60,000 as the cash value. Now, you tell the insurance company that, can you get $80,000 from the policy? I mean, from the cash value. You don't have up to $80,000. The insurance company will tell you, so of course, we will. We will give you, our customer want you to live well for us. They write a check of $80,000 and send to you, you collect. Now, on the tax aspect of it, remember what you have as a collateral is what? $60,000. Now we have collected $20,000 extra. You are going to pay tax on the $20,000 you collected extra. And however, that $20,000 is somehow coming from the death benefit. So you are required to pay tax on the $20,000. So that's exactly what we're talking, taxation on the loan, policy loan. That's what we're going to see here now. We discussed about MEC already. So borrowing against the cash value may be referred to as a partial surrender. When you borrow against the cash value, they require as a partial surrender. This action on the part of the owner, while not resulting in a taxable event, does lower the owner equity in the policy. Of course, it does lower the equity. When you get a loan from your policy, you're lowering the equity. You're lowering the growth of the cash value. So if a total surrender occurs, the cash value received is not taxable. If you decide now that you are no longer going to going to continue with the policy, you have their surrender, cash surrender. They're not going to apply tax, no taxation will be applied in it. Remember, the cash surrender value is coming from your premium. The part of it is coming, almost all of it is coming from your premium. So there'll be no tax there. Now, if you do exceed the total of premium paid by the owner, that is the cost basis. Additionally, when a contract owner borrows against the cash value of a whole life policy, the interest paid to the insurer is not taxable. But if it's above, definitely going to pay tax on it. The insurance policy scenario, tax implication of policy load. Let's see. Let's just use it so that everybody will understand it better. John owns a whole life insurance policy with 100,000 cash value. So John was able to have 100,000 cash value on his policy. And we have discussed in the morning that what can make you to start generating cash value fast in your policy is you have to pay annually. That's what we said in the morning. Remember? That's what will make your policy to grow cash value fast. So his total premium payment cost basis are what? 75,000. That's how much he pays as a premium cost basis for annually. So he is what? Considering borrowing 30,000 from the policy to fund his daughter's college tuition. Remember, he has 100,000 on his cash value. Let's see what happened. If John's policy is standard whole life policy with cash value, the 30,000 loan won't trigger taxes. Why? Who can answer?
Sir?
Why the 30,000 loan won't trigger taxes? If John has 100,000 and is borrowing money from borrowing 30,000 from the policy, and he has 100,000 cash value, he said the 30,000 loan won't trigger taxes. I asked why.
Because he didn't go beyond what he has.
All right, good one. Then the loan reduces his equity. I want everyone to know that he cannot pay tax because he didn't go beyond above what he has as a cash value. So no tax implication is involved. But however, he has reduced his money, means that the equity on that policy has been reduced. So since he has taken loan, the best thing for him to do to bring the equity back to where he was before was to pay back the loan. So you can see the reason why you should pay back your loan from your account. If you borrow from your account, you have to pay back. You may not decide to pay back. Nobody will call you to pay back. But for you to continue to grow the equity in the policy, which means to continue to grow, he has already 100,000. In this 100,000, John can confidently come there and get 80,000 or get 90,000. He's not going to pay tax on it. But the advice is that pay back the loan so that the equity will not be affected. If he remove 90,000 from this 100,000 cash value, he has almost reduced the equity to zero. So except he continues to pay the loan back, that is the only way he can bring his equity back. I hope everybody understood that. So the loan reduces his equity, the equity in the policy. The interest he pays is not tax deductible. Of course, if it goes above, the interest will be there. All right. I think taxation of accelerated benefit.
I'm sorry, but what is the equity of equity?
Equity. Right, let's go back there. All right. The equity, let me just give you an example. For life insurance, let me start with equity in your mortgage. Do you have a mortgage?
No.
All right. If you see people who have a mortgage, let's assume you buy a house, 400,000. 400,000, that's what you bought a house, 400,000. I'm a realtor. So you come to me, say, oh, Mr. Bart, I want to buy a home. I ask you, how much do you have? You say, you have 300,000, want a home of 300,000. So, all right, I will look for a home of 300,000 for you. I got a home of 300,000. and you get a loan, you're able to process the payment and through the loan officer, and it went through, you finally got your home 300,000. This maybe you bought that home 2000, the year 2000, or 2020. You bought the home 2020. Now, that was the cost of that home the year 2020. When you bought it, it was 300,000. Now, this is 2025. This January, you decide that you want to go out again, want to go outside to go and buy another home because you don't like that place again.
Yeah, that's your number.
Then I ask you, I said, please, you want to sell the one you have now? You say, yes. You say, you want to sell it? I said, all right. How much do you think it is now? You say, if somebody give me 350,000, I take. I begin to look for somebody who will buy 350,000. What happened? I finally get somebody who bought it 350,000. Then my question to you would be, you selling that house 300,000, 350,000, the house you bought for 300,000. Now you sell it 350,000. The 50,000 is the equity.
So it's the profit that you have.
Yes, it's a profit, but I want to, I'm seeing on something. I want to tell you something. So
thank you. I'm sorry for taking you guys.
No. It's okay. Why we're here is to learn. So we learn now. We are learning both real estate and everything. We are learning it now. So the 50,000 is what is the profit you have there. So my question to you is this: that $50,000 you have as a profit, do you think you sell that house above 300,000 you bought it because the house is now new? Is that the reason why you sell it 350,000?
No.
This house is old. You bought it 300,000 when it was new. Now you are selling it, you say 350,000. 50,000 is your profit. Then the question is that, do you think what you sold it because that house is newer than when you bought it?
No.
No. I think?
No, yeah.
All right. So the equity in the house, I saw this before we go to cash value. The equity in the house is what makes up of the house. It's not the structure. One is the environment. Two, the development around that home. Three, the land cost, which can be affected by the development around that home. So all those things put together, you can see that area now, because when you lived in India, there is no police station. Now there's police station. When you live in India, there is no hospital. Now there is hospital. The environment, the development in the environment becomes the equity. So that is why you can get money if you refinance your home, you can get money out of your home. Because what? The value of that home has appreciated. And what caused the appreciation is not because the house is new and no. It's because of the environment, development, the cost of the home. All those factors put together is what we call the equity in real estate. Now let's go to equity, why we call cash value as an equity. Remember, we said it in the morning, for those who are in the morning, cash value is part of your premium.
Oh, I know the cash value, but I didn't know it was the same thing.
Yeah, so cash value is a part of your premium, is a section of your premium put aside to yield more money for you. So as this yield, they call it equity because it comes out of the work, after how the interest or the stock market or the market trend occurs. So the equity now becomes what is happening with that cash value as it continues to grow. If you buy a whole life policy, the whole life policy we say is matured, is endowed at the age of 100. By that age of 100, we are now saying that the cash value, that little money you put there that have been developing equity for you, is now equal to the first amount. So that's the time we now say the policy is endowed, means that the policy is paid off. At that point, you are not expected to pay any premium again because the target of cash value to be equal to the first amount has been attained. So in that case, you're not required to pay any premium again. So that is equity. You're right. You get it now. So let's go out.
Yeah, thank you so very much.
You're
I
welcome.
appreciate it.
So let's go out and see taxation on policy dividends. Of course, I've talked about policy dividend. Why tax will be applied on your dividend. And the part that tax will be applied is the part that accumulated. The accumulation part of it is what you pay tax on. So there's no need to go back there again. Modified endowment contract, MEC. We have already said everything about the MEC, but for the sake of those who were not there with us, let's look at it. When you overfund your policy, you have to follow, when you are paying for your policy, the IRS rules that concern life insurance policy is like you must follow the 7-pay test, which is the maximum you can put in your policy for that 7 years. You have to follow that 7-pay test. That's what the MEC said. If you overfund your policy so that it goes above this 7-pay test, if you have written your policy, you understand what practically the meaning of 7-pay. So if it goes above that 7-pay test, meaning that you have overfunded your policy will lose the credibility of a tax, of life insurance. Now it becomes an investment. If it now becomes an investment, everything around it will be taxed. So that's what we call MEC. So everybody's trying not to allow his policy to be a MEC. If be a MEC, if it looks the insurance contract benefit, which the IRS has given insurance policies to be without taxing. If it goes above it becomes a MEC, what happens? IRS will now recognize this as an investment. You now become to pay tax, even in loan, in everything. Even when you borrow, if you take anything from there, it become taxable. So that is practically what it means by MEC. So always nobody want to make his tax, his policy a MEC. We always try to avoid that. The insurance company will always try to help you to avoid it. As an agent that you will be, you're still going to avoid your policy or your customer's policy to be a MEC. So you try to avoid that. Who's making noise here? All right. So the following illustration illustrates the tax treatment of a MEC benefit. So when your policy becomes a MEC, look at the tax treatment on it. Taxation occurs only when the cash is distributed to the contract owner or money is withdrawn. There will be a tax. When the cash is distributed to the contract owner, which is the policy owner, what happens? Money is withdrawn, there will be taxation on it. Whether through surrender, a loan, or dividends, there will be tax. Another one again is gain. When there is a gain, that is interest or appreciation is taxable first when the distribution is made. There is be tax on it, which is called LIFO. The first dollar received by the contract owner are considered earnings first. So anything you can do from that policy is now taxable. Or excess amount of cash value beyond premium and are taxable. If a policy is a MEC and the cash is withdrawn, the amount are still taxable. Even if they are used for legitimate reasons such as what? Financial hardship or medical expenses, you still pay tax. If a cash is withdrawn prior to age 59.5, a 10% penalty tax will be assessed. So you can see, you don't want a policy to become a MEC. So you try to avoid that, but it's good to know what it is. And it's your duty to ensure that your customer does not, policy does not go to MEC. So let's look at this 1035 exchange. We have already discussed 1035 exchange. You can use it to exchange a life insurance policy or endowment or annuity contract from another of like kind. For instance, you can use 1035 to change your policy. In fact, even when you roll over, I did a rollover from 403B to annuity. They sent me a form 1035, which I filled and sent back to them. So 1035 can use it to roll over. 1035 is just a paper. It's a revenue code, internal revenue code, that permits individuals to trade or exchange a life insurance policy. So you use 1035 to exchange your policy. Just as I told you now, I see my own for rollover. When you're rolling from your 401k to annuity, you use 1035 on the rollover. So it's easy to exchange or transfer your policy from another one to another. If you are transferring from, if you're making, let's assume you have term life insurance. You now decide that you're going to convert your term life insurance to whole life insurance. You're going to use 1035. So 1035, that's why they call it 1035 exchange. It's just a paper. It's not a thing that you will see. It's just a paper. So I think that's why we're going to stop it there. Chapter summary, we're not going to go to this summary before again. However, for benefit of those who just joined us today, let's briefly look at the summary before we answer the question and close for the night. What we did in this chapter, we explored the fundamental relationship between what? Life insurance premium, proceeds, and beneficiary. We talk about the core elements that make life insurance work as a financial protection tools. And what are those elements? We talk about them. We talk about taxation. We talk about premium, proceeds, beneficiary, taking of proceeds, who's supposed to take proceeds. So those are the things that makes life insurance as a financial protection tools. Of course, it's regarded as a protection tools because the proceeds comes out, proceeds go to the family when the insured is no longer alive. If the family is well groomed, they're going to use that proceed to put themselves in the right order. Although no amount of benefits will be equated to somebody who passed, no. Life, no. But however, they're still going to use it to make sure that those who are alive keep themselves well. So we also begin by examining how premiums served as the consideration that bind the insurance contract. Remember, in insurance contract, we talk about consideration. I hope everybody remembers that. A contract is between two people, the policy owner or the insured and the insurance company. And each of them has a consideration in place that makes the contract. Consideration in the part of the insurance company is only one. And what is that? The promise to pay the benefit. That is their own consideration. The promise to pay the benefit. That is only consideration. And that's their consideration sometimes can be called insuring clause. And also is conditional. It's conditional based on what? When the loss occurs. So I want everybody to remember all this. Now, we talk about, again, consideration in part of the applicant, which can be me and you. Our own consideration on the contract is what? Our application, which sometimes we call statement or otherwise representation. And what? The initial premium. Those are the two considerations we have to the applicant. And these three considerations is what makes up the contract. So that's why premium serve as the consideration that bind the insurance contract. Of course, if you write the application without the premium, you have not fulfilled their consideration. The consideration, their own consideration part of the contract. There's no contract because you have not fulfilled it. You only write the application, and that such application are called trial application. It does not go anywhere. It's just a trial application. If you wrote the application, they can approve it. If they don't, before your policy become active or before your policy can be issued, you must, however, pay your premium. So premium is your completion of your own part of the consideration. Of course, the consideration on the part of insurance companies, they promise to pay the benefits. So when you get your two consideration and their own, it becomes a contract. So, and however, we talked about insurance calculated premium, how insurance company calculate premium. The three factors they use to calculate their premium today is what? Mortality, interest, and expense factors. Those are the three factors the insurance company use in calculating premium. So if you have a premium today, that's the three factors they use in calculating their premium. They want to talk about the mortality, the interest, and the expense factors. Those are the three things. Now, we went ahead to learn the personal characteristics like age, gender, health history, and lifestyle significantly impact premium costs. So all those in fact, premium costs. So that's why we keep on telling our people the best thing can do to that child is to get his policy now that it doesn't have any record. And we said we'll equally learn about various premium payment method. We say you can pay a single premium, which is one-time premium, funding to, and we talk about the flexible premium option, where you can pay as flexible as it is. You pay today, you pay monthly, or you pay annually, or you pay semi-annually, depending on where you want it. We'll pay the way that's easier for you. But however, our advice is that at least you pay annually in all your policy to avoid your policy elapsing, and moreover, to fastly generate cash value for you. So the chapter also shifted to policy proceeds, how policy proceeds are being distributed. What is that proceed? The death benefit. We talk about the standard 5-state settlement options. The way your proceed can be settled, which means the way you can design your beneficiary to collect the proceed, is 5 ways. We call them settlement option. One of them is lump sum. You can decide to collect the proceed lump sum. That is, the beneficiary can collect the proceed or the death benefit lump sum. They can collect interest only. In the interest only option, what happened? The benefit or the proceed are kept with the insurance company. The insurance company will be paying the beneficiary interest from the proceed. That is another option. That is settlement option. One is lump sum. Second one is interest only option. The third one is fixed period. You have a period you marked to be able to get the proceed. You can say, pay me every December. You can say, pay me every month. You can say, pay me every 6 months. That is fixed period. The fourth one is fixed amount. You can decide how many can be paid to you. How much can be paid to you? Maybe 1,000, 2,000 every month, depending on what you want. The last one is life income. Of course, you can decide to have your settlement option in life income, where you can continue to receive income to your whole life. But the only thing with life income is this: the insurance company will get the money and put it on immediate annuity, fixed immediate annuity. Based on that, you can receive income for life. So that is the 5 settlement options. Please, you have to know them. And again, we went ahead to talk about how each serve different beneficiary needs. We examine the importance of proper beneficiary designation and the difference between primary, contingent, and tertiary beneficiary, as well as per capita versus the per strip distribution method. Of course, per capita is the normal one we do. Per strip is when you decide you don't want to do the normal one we do. You want to do as per people who are in the family, the heirs in the family, without even the policy owner or the insured deciding that. When the insured did not make such, the insurance company can decide. If you choose per strip, the money will be distributed to the heirs in the family. So that's what we discuss. We talk about special provision like the word common disaster clause, spendthrift clause. We are discussed. Of course, everybody knows what spendthrift clause. Spendthrift clause is a clause bring about by the insurance company. Is a clause that bring by National Association of Insurance Corporation. And what does that spendthrift clause do? What is this? That it protects the beneficiary from people like IRS, like student loan, like your landlord or anybody from challenging or coming to challenge the beneficiary concerning what the proceed, concerning the death benefit. So the spendthrift clause protects people, creditors, from coming to you to say, because the person is owing me such amount, give me the money. Of course, he has the death benefit, he collected the death benefit. So that's what spendthrift clause protects. We went against ahead and talk about I think that's where we end today. That's where we end. So let's go and answer the question. That will help us to understand. That will be the end today. Listen to this, then we answer the question. We close for the night.
Great job completing the life insurance premiums, proceeds, and beneficiaries chapter. Let's recap the key concepts you've learned to help you prepare to pass with confidence. Life insurance is more than a contract. It's a financial promise. In this chapter, you explored how premiums are calculated, how benefits are paid, and how beneficiaries are designated. You also learned that premiums are based on 3 key factors: mortality, interest, and expenses. Mortality reflects the statistical likelihood of death, which insurers use to estimate risk. Interest represents the expected earnings from investing premium dollars before claims are paid. And expenses cover the insurer's operating costs, things like underwriting, marketing, and administration. Think of it like a triangle. Each side influences the final cost of coverage. The better insurers manage these factors, the more competitive the premium. We also covered different premium funding methods like single, level, modified, graded, and flexible. Each method offers a unique payment structure. Next, we explored how benefits are paid out. These are called settlement options. Whether it's a lump sum or a monthly income for life, each option serves a different purpose. Next, you learned about life income settlement options. This is a way to turn a life insurance payout into guaranteed lifetime income for the beneficiary. The straight life income option pays the highest monthly amount, but only while the beneficiary is alive. If they pass away early, any remaining funds stay with the insurer. The life income with period. Certain option guarantees payments for life and for a minimum number of years. If the beneficiary dies early, a secondary payee receives the remaining payments. The life income with refund option ensures the full death benefit is paid out. If the beneficiary dies early, the remaining balance goes to a secondary payee, either in installments or as a lump sum. The joint and survivor life income option provides income for 2 people and continues after one passes. Payments may reduce after the first death. Each life income option balances income needs with risk. Whether maximizing monthly payments or protecting loved ones, understanding these choices helps beneficiaries make informed decisions. Let's talk about beneficiary designations, a key part of any life insurance policy. You've learned about primary, contingent, and tertiary beneficiaries and how proceeds are distributed based on succession. But here's something important to remember. Beneficiaries aren't considered parties to the insurance contract. That means they don't have control over the policy itself. However, there's one exception: an irrevocable beneficiary. Once named, an irrevocable beneficiary can limit the policy owner's rights. That includes the ability to change beneficiaries, access the cash value, or even surrender the policy without their consent. We also covered distribution methods, per capita and per stirpes. These determine how benefits are shared among heirs. Before we move on, let's take a moment to explore 2 key provisions that help guide where life insurance proceeds go, especially in situations where the order of death is unclear or the result of a shared tragedy. First, there's the Uniform Simultaneous Death Act. This law applies when it's unclear who died first, the insured or the beneficiary. In these cases, the law assumes the beneficiary died before the insured. Why does that matter? Because it means the proceeds won't go to the deceased beneficiary's estate. Instead, they're passed to the next beneficiary in line or to the insured's estate if no other beneficiaries are named. Now let's go a step further with the Common Disaster Clause. This provision kicks in when both the insured and the beneficiary die from the same event, but not at the exact same time. If the beneficiary dies within a specified period, say 30 days, after the insured, they're still treated as having died first. In that case, the proceeds go to the contingent beneficiary, or again, to the insured's estate if no one else is listed. These rules may seem technical, but they're designed to prevent confusion and ensure the benefit reaches the right hands, even in the most difficult situations. The Spendthrift Clause protects beneficiaries from creditors and reckless spending by controlling how proceeds are distributed. Finally, we explored the tax consequences of life insurance. While death benefits are generally tax-free, interest earned and certain transactions may trigger taxes. You also learned about modified endowment contracts, MECs, 1035 exchanges, and how dividends and policy loans are treated under tax law. As you finish this chapter, take a moment to review the key notes in the next section. Discuss the concepts with a peer and complete the practice exam. These steps will help solidify your understanding and set you up for success on your exam. You've done a fantastic job. Keep up the momentum and continue to prepare to pass with confidence.
All right. So we're gonna go through the exam. We're almost done for the night. Let's fastly go through the exam. So tomorrow we're gonna start from life insurance underwriting and policy issue. Chapter 7 is another good chapter that I want everybody to be part of, and make sure you really participate on it. Life insurance underwriting. In there, we're going to know why underwriting is in place. So let's start. Remember the way I told you to answer this question? You always have 4 options on this question. So I will want you to use elimination method, whereby you go through the option and take away the 2 options that you think does not relate to the question, to the answers. Take them off and battle between 2 questions. Then it's better for you to make a choice on the 2, because when you are battling upon 2 options, you have 50-50 chances of getting it right. So even if you make a guess, you have 50% chance of getting it right or 50% chance of getting it wrong, which is 1 out of 1. So do the writing and do the writing. Do elimination method. So let's go. Number 1 said, which of the following statement is correct regarding the tax treatment of a lump sum payment paid to a life insurance policy primary beneficiary?
Pay for Apple.
Any other person? Any other person? Any other person? How many of us here? We are 14 or 13.
We are 13 now.
All right, somebody should, somebody say A. All right, if I just say A, so we're gonna go to, all right, so the all proceeds are income tax free in the year they are received. Please remember, it's tax. There's no tax in life insurance, please. When can a policy owner change a revocable beneficiary? When can you change it?
Anytime. Pay for Apple.
Right.
Anytime.
All right. Can change it anytime you like. If the person gets you annoyed, just remove the person. Remove the person and create another person. Which premium schedule results in the lowest cost to the policy owner? Which of them is to the lowest cost?
Annual.
Any other person?
C for Charlie.
All right. Annual.
Annual. I'm answering and my thing was muted.
Yeah. When you pay annual, you pay more. You pay less. When you
Less.
pay monthly, you pay more.
Who has the right to change?
So who has the right to change the revocable beneficiary?
Policy owner.
Boy, B for boy.
Policy owner.
Policy owner.
Yeah. So there's one. What is
Can you make that? Can your font be a little bit bigger?
All right. Hold
please,
on.
guys. I'm strict.
Oh, let me do it. It's okay.
And oh my God, much better.
All right. So what is the underlying concept regarding level premium? So what is the level premium? You have to know what level premium means before you answer it. What is the underlying concept regarding level premium? What is the level premium? That is the question you have to answer. What is the level premium?
Level premium bill cash.
It's between B and D. Let me see.
A for Apple.
Listen to me. A bill cash. I say A and I stick to it.
Right.
A bill cash value.
Level premium build cash value. Why can you say level premium build cash value? What is the underlying concept?
Mr. Kevin is right. D. Mr. Kevin, you're right. Level premium don't build cash.
Level premium, see, the correct, even this answer, I question it. Level premium is when is level, means that the premium remains the same. It do not change. Flexible in when the premium varies. When you can pay today $100, the next day you have $200 you pay. But level premium, fixed or level premium means that level remains the same throughout the life of the policy. more especially in term life insurance, use a level premium. But however, the answer said the early years are charged more than what is needed.
That's charge. I think it's change.
Which is correct.
Charge.
Which is correct.
Oh, I think I change.
So,
that's what I mean.
So M purchased an accidental death and dismemberment AD&D policy and named his son as beneficiary. Emma has the right to change the beneficiary designation at any time. What type of beneficiary is his son?
B for Bravo.
Revocable. B.
So a policy owner is able to choose the frequency of premium payment through what policy feature? You choose your premium payment on what policy feature?
A for Apple.
All right. Any other
A for Apple.
Is premium mode. Premium mode can be monthly, can be annually, can be 6 months, every semi-annually, can be quarterly. You decide what is good for you. Now, a policy owner would like to change the beneficiary on a life insurance policy and make the change permanent. What type of designation would fulfill this need? He changed the beneficiary and make it permanent. What kind of designation is this?
Yes, boy.
B for Bravo.
All right.
B for Bravo.
It's irrevocable. You change it and it becomes permanent. You do not have
permanent.
But I don't know who will do that. That irrevocable beneficiary. So a primary beneficiary has died before they insured a life insurance policy. A contingent beneficiary is named in the policy. Which of the following will occur when the insured dies?
A for Apple.
A
for Apple.
I know you hammered on it. A.
All right. So proceed will go to the contingent beneficiary, of course. So K is the insured and P is the sole beneficiary of a life insurance policy. Both are involved in a fatal accident where K dies before P. Under the common disaster provision, which of this statement is true? We discussed this a lot today.
Yeah.
Read it for me, because we can't see it. Good.
I think it's A.
So which one is which option is correct?
We can't see that too far.
A.
All right, somebody say A. Then we're gonna do and close. Proceed will be able to K estate if B dies within a specified time. Did you guys see this? K is the insured and P is the sole beneficiary. I don't know why you guys should think about this. K is the insured and P is the sole beneficiary. It doesn't have only one beneficiary. Now, two of them die in a plane crash. Where will the benefit go?
Okay, no,
it goes to the estate because two of them have died. It doesn't have a secondary beneficiary. It's like when you don't have any beneficiary at all. It doesn't have a contingent or secondary beneficiary, neither tertiary beneficiary. It doesn't have none. It has only one beneficiary, sole beneficiary, and the two of them died. So the proceeds go to the estate. The dash of personal life insurance premium is usually deductible for a federal income tax purposes. This one is, everybody's supposed to know it. What percentage of personal life insurance premium is usually deductible for federal income tax purposes?
Is 0.
Right. Do we tax insurance?
No.
Policy, no. Right. Dash and a beneficiary may be changed by the policy owner without the consent of the beneficiary.
Revocable.
All right. Yeah. So a level premium indicates what? What is a level premium? Just like what you answered before.
B for Bravo.
B, C.
B for Bravo.
So somebody say B, another person say B too.
B for Bravo.
The premium is fixed for the entire duration of the contract. I just said it 1 minute ago. A policy owner is allowed to pay premium more than once a year, under which provision? A policy owner allowed to pay premium more than once a year, under which provision?
D as in David.
D as in David.
Mode of premium.
Cost mode of payment, mode of premium. All right, this is not mass.
Anything like this, they scare me.
No. Let me tell you, when you see something like this, don't get scared. They're just using that word to scare you. Some of the word is distractions. Nothing. So T and S are named as co-beneficiary in what co-primary beneficiary in a 500,000 accidental death and dismemberment policy insuring their father. Their mother was named contingent beneficiary. 5 years later, S dies of natural causes and father is killed in a scuba accident shortly afterward. How much death benefit will the mother receive?
The full amount, 500B.
The 500 something. B.
Think quick. Think well.
David.
Think well. Remember what questions, what I said before. Do not use your own reasoning to answer questions. Read that question again and think well.
D.
0.
D as in David.
0.
0.
Look at this. T and S are named co-primary beneficiary, and one of them died with the father. The mother is the contingent, which is the secondary beneficiary. They're asking you how much benefit will the mother receive. The mother is not going to receive anything because one of the beneficiaries is still alive. Do you see one of the beneficiaries is still alive? So the mother is going to receive 0. So you when you say 500,000, you use your own knowledge to answer the thing without looking at what is going on there. Because in the normal sense, in our own, the mother will receive the beneficiary. That is our normal conclusion. But in this question, it does not apply because 2 of the beneficiaries, one of them is still alive. So there's no way the mother can come in. The mother is a co-beneficiary. I mean, contingent beneficiary.
Secondary.
So it cannot happen. So I think that is it. So
we tried.
That is what we're gonna end for today. Tomorrow, I think tomorrow is what, Saturday. So Saturday we normally do, I think 2 p.m. Central, if I should be correct.
Is it 2 p.m. or in the evening?
Oh, 6 p.m. Central.
6 p.m.
All right, 6 p.m. Central. So we're gonna see tomorrow 6 p.m. Central. If I didn't post it, you know that it's 6 p.m. Central. So just like the time we normally start today. So 6 p.m. Central is when we're gonna see tomorrow. All right, good night, everybody.
Good night. Thank you so much.
Yeah, bye-bye.